when I was thinking of this topic, one such area which needs attention, and I thought can be an area where I can add more value, and that is to discuss about the valuation of unquoted shares under Rule 11 UA1CB. And why is that? Because many in majority of the times the valuations are being done of unquoted shares, and the Rule 11 UA1CB has prescribed a formula, has prescribed a methodology. However, this methodology is still fraught with a lot of ambiguities, lot of confusion, and there are areas where one is not sure as to what should be considered as an asset while taking the value of the assets, even though Rule 11 UA1CB talks in terms of the method which is NAV. Now, if you really analyze it, and I'm sure together we would do that, you would notice that it is really speaking not a net asset value method, because the meaning of net value asset method would mean that you pick up balance sheet of a company, take the total of all the assets that the company has, take total of all the liabilities that the company has other than the equity shareholders fund, and the difference between the two becomes the NAV, net asset value, and that becomes the value of the entity if NAV was to be followed. But when you analyze and look at the methodology prescribed under Rule 11 UA1CB, you would notice that the formula provides in certain cases for taking the assets and the liabilities on the face value or on the values which are given in the balance sheet. Whereas in case of certain other items, the value is to be adjusted. And that is why I say that this is not really speaking is NAV, it is rather a combination of NAV and adjusted book value method, or rather I would say it is a adjusted book value method. Friends, today in this session we will discuss number 1, Rule 11 UA1CB for the purpose of doing valuation of unquoted shares as to what the provisions are. Not only we do that, but we will also take up a case study that would cover all aspects of Rule 11 UA1CB, so that together we have total clarity with regard to all the provisions of this methodology which is prescribed under Rule 11 UA1CB. That is what is my endeavor. I would always love to have the sessions interactive, but since we are in the virtual scenario, it becomes really difficult. But what we will definitely do is towards the end of the session, I'm going to leave some free time, and that is where I would be happy to take all your questions and all your queries. So let's begin with the basic understanding of Rule 11 UA1CB for the purpose of valuation of unquoted equity shares. Now this Rule 11 UA1CB, friends, talks in terms of a formula, and that formula is A plus B plus C plus D minus L. A stands for the assets which are to be picked up as given in the balance sheet, to be adjusted with the amount of the excess of provision that the company may have made over and above the actual liability, tax liability. So that is your A. B is for the valuation of jewelry and other work of art and things like that. C is for the valuation of unquoted shares and also unquoted other securities. And D is with regard to the valuation of immovable properties. And L is for the liability. So what you do, you first find out all the items of A, add them together, adjust them for the amount of income tax provision which may have been made in excess then what is required. Then add the value of the jewelry which the company may be having on record, and that value of course is to be adjusted. So the value of jewelry will need to be adjusted for its current value, so it cannot be taken whatever is given in the balance sheet. Same is the case in case if the company is also having unquoted equity shares of another entities or unquoted other securities other than equity shares. So those will also need to be added as part of C, and then as part of D, of course, you will take the value of immovable properties. All said and done, let us understand and be very clear about one thing, and that one thing is through this methodology or through this formula as given in Rule 11UA1 small c small b, the purpose is to derive the fair market value. The purpose is to derive the real value of all the assets and the liabilities given there. Now, since it is a method which is based on the balance sheet, therefore, as I understand, there is no requirement of taking help. There is no requirement of getting a report from a registered valuer. But though it is not statutorily required, but you will see with regard to the certain components like gold jewelry, or work of art, or unquoted equity shares, or unquoted other securities, or the immovable properties, you will definitely require valuation report from a registered valuer. And here, friends, I would like to clarify that the registered valuer here, in my understanding, is not the one who is registered with IBBI. For the purpose of 11 UA1CB, in my view, the valuer that will be used is the one who is registered under Section 34AB of the Wealth Tax Act 1957. So, it is even if the company whose shares you are trying to value or unquoted shares which you are trying to value, even if that balance sheet does not have jewelry or unquoted shares or work of art or any immovable property, I will very strongly recommend, even in that case also, obtain a valuation report from a registered valuer who is registered for securities and debentures and financial assets under the income tax, for the purpose of income tax under section 34AB of the Wealth Tax Act 1957. Why? Because all said and done, this report will safeguard you against any uncertainties which might be raised by the department tomorrow. So you would be able to support your decision or your conclusion backed by a report which is coming from someone who is authorized to do the valuation, and that is what is my recommendation with regard to these valuation of these unquoted equity shares. Now, friends, a question that I would like to ask all of you. You do not have to answer it per se, but then just think about it, because this question is going to help us be very clear about the methodology for valuation of unquoted shares. So what is the philosophy and objective of the department behind Rule 11UA1CB for determination of fair market value of unquoted shares. So ये जो formula बनाया है, let me tell you friends, this formula has really been prepared very scientifically. So anyone who has, or the people who have worked upon this formula have really applied their mind very extensively and have given a formula which is really fair to the department and also to the assessee, provided both of them work without any bias or prejudice. So the answer to this question is the department, the philosophy and the objective of the department behind Rule 11 UA1CB is assets not only for Rule 11 UA1CB but otherwise also. Assets should not be understated and liabilities should not be overstated. Thereby, the fair market value should be maximum so as to have maximum capital gain, to have maximum tax. Now, this is the philosophy and the objective behind Rule 11 UA1CB as far as the department is concerned. So, they would like to ensure that the fair market value is worked out in such a way so that there is a maximum capital gain, and since there will be a maximum capital gain, apparently there will be a maximum tax as well. So before we come to the case study, a quick review of the provisions of Rule 11 UA1CB. So the formula, as we were discussing, is A plus B plus C plus D minus L. Now one by one we will look at this. So what is A stands for? A stands for taking all the book value of all the assets. That means, so the company whose unquoted shares, so obviously the moment you talk in terms of a company which is unlisted or a company which is private limited, obviously that is the case where this will be applicable, because these are the companies whose shares are referred as unquoted shares. So when you want to determine the fair market value of such a company, you start with A, and what A stands for? Book value of all assets. Mind you, book value of all assets given in the balance sheet of the company, with an exception: jewelry, artistic work, shares, securities and immovable properties are not to be taken at this juncture. They are to be dealt with separately. So that is what you need to do. So you pick up the balance sheet, other than these five things that I have just mentioned, take all the other assets, and you will have to make some adjustment in that amount. And what that amount, that adjustment that you have to make, that adjustment is any amount of income tax paid, if any, less the amount of income tax refund claimed. Now that difference will need to be deducted from the total of book value of all these assets other than these five assets. So that's your point number one, and I'm sure it's very clear to every one of you. Number two, what you need to adjust is any amount shown as an asset, including the unamortized amount of deferred revenue expenditure. So what you do, from the amount of A, not only you deduct the amount of excess amount of the excess tax or the excess provision that you have made, but you also deduct unamortized amount of deferred revenue expenditure. Now what is this unamortized amount of deferred revenue expenditure? Friends, just to give you an example, in the past, I don't know how much it is practiced today. In the past, or for that matter, at times companies incur heavy expenditure on promoting their brand or on promoting their products. And whenever they, let's say for example, Maruti or Tata Motors or Hyundai or any other automobile company or any other company for that matter, they are introducing a new product first time in the market. So when they are introducing a product first time in the market, they need to spend extraordinary amount on the advertisement and the promotion of that product, so that that product gets entrenched in the minds of the people. Now, this is not an ordinary expense that you are incurring when you are launching a product first time. This is an extraordinary expense that you are incurring. That means the size of the amount that you spend is quite large. So now what you do, you will not book typically in the accounting. Of course, there are different treatments under the Indian GAAP and Ind AS. What that may be. Uh, for how do you do the accounting? You do the accounting of this expenditure in the books and show it as an asset. You don't suppose, say for example, Maruti has spent 50 crore rupees on launch of a new product. So what Maruti will do, they will not book the 50 crore as an expense on account of advertising and the sales promotion. They will book that 50 crore as an expense under the head unamortized amount of deferred revenue expenditure. And what is the logic behind this accounting treatment? The logic behind this accounting treatment is company feels that this expenditure of 50 crore which the company has incurred on promoting the product, the benefit of this expenditure are going to accrue to the company not only in the current year but also in next 5 years. So therefore what the company would do, company would show this 50 crore as deferred revenue expenditure in the balance sheet, and it will write it off over a period of 5 years. So 50 crore है 10 crore करके 5 साल में they will write it off. So at the end of first year, second year, third year, you will have some amount which is not written off, right? So amount which is unamortized. Now, really speaking, when you want to do the fair market value, you want to ascertain the fair market value of this company. Now, please tell me this 50 crore or this 50 crore 50 crore of deferred revenue expenditure, which is appearing in the balance sheet of the company, is it really an asset? And the answer is no. It is only a fictitious asset. It is only a nominal asset. It is not even an intangible asset. It is only an asset for the namesake and only for the purpose of accounting. So that is why the rule 11 UA1CV says that if the balance sheet that you are trying to value contains any amount on account of unamortized amount of deferred expenditure, then such unamortized amount of deferred expenditure also got to be excluded from taking the figure of A. And that is your point number A as far as the valuation of unquoted share is concerned. Now, before I come to B, C, D, and L, let me ask you a few questions, few posers. Again, you do not have to answer them. Just ask it yourself and answer it in your mind. Will A in above formula include tangible assets? So when this formula says A talks in terms of book value of all assets. So will this all assets include only tangible assets and not intangible assets, or will it include both tangible assets and the intangible asset? And friends, the answer of course is very simple and very clear. It will include tangible assets as well as intangible assets. And intangible assets like brand, logo, patent, copyright, technical know-how, customers list, software. Now these all are intangible assets. And please remember, these are intangible assets, but these are not paper assets, because these assets are used by the business in running their operations. And therefore, as part of A, intangible assets will also be included. They will not be excluded. Number two, will CWIP, capital work in progress. So capital work in progress, remember, is an item which is not yet complete, but it is appearing in the balance sheet as an asset. And this capital work in progress can be on account of tangible and on account of intangible assets. So the second question is, will the amount of capital work in progress for tangible assets or for intangible asset, will it be included as part of A? And the answer is of course yes. Just because it is capital work in progress, it does not mean it becomes worthless asset. It is capital work in progress. halfway through, and it is going to be completed in the due course and be put to use in future. And therefore, capital work in progress will also be added and included as part of A. And the third poser is what should be the date of balance sheet for the purpose of determination of fair market value of the unquoted shares. Now, friends, I was trying to study and research and find out as to if there is any explicit mention somewhere which says that the balance sheet has to be balance sheet has to be audited for every valuation that has to be done of the unquoted shares. And unfortunately, or incidentally, or fortunately, I could not find anything. So therefore, in my view, it is not necessary that every time someone is wanting to transfer unquoted shares, somebody is wanting to do the valuation of unquoted shares of a company. In my view, it is not necessary that every time someone is wanting to transfer shares, unquoted shares, he has to get a fresh audited balance sheet of the company. In my view, that is not correct position. Remember, in my view, it is enough that you pick up the last audited balance sheet, and based on the last audited balance sheet, you do the computation of fair market value. Remember, as far as this formula is concerned, this formula has already provided that the all assets other than jewelry, other than artistic work, other than unquoted shares, other unquoted securities, other than immovable properties. So the formula has already provided that if this balance sheet contains these items, then for these items valuation has to be done specifically. But for the other items, you pick up the figures simply from the balance sheet and use them for the purpose of determination of fair market value as per Rule 11UA 1 uh, 1 CB. Right. So, in my view, I'm saying it once again. In my view, it is enough that you pick up the last audited balance sheet. Please remember, is it practically possible if a company has 3, 4, 5 shareholders wanting to transfer their shares? So, do they have to every time ask the company to do the audit of the company and prepare a balance sheet because he wants it? And tell me, how practical will it be for any company to do the balance sheet, audit the balance sheet for every transaction? Because audit is a complete rigmarole. It is not a 1 day process or 2 days process. Audit means it has to be complete audit. And remember, you are picking up a date in between, and therefore, how can you be ever sure about the numbers that would be presented in the a fresh audited balance sheet? So therefore, my view is last audited balance sheet, whichever is available during the whole year, is good enough for this purpose. I am sure the tax authorities will also understand and appreciate that it is practically not possible for anyone to ask the company, I want to transfer my shares, I want to do the evaluation of my unquoted shares, please do the audit of your company and give me the audited balance sheet. Now, please remember, audited balance sheet becomes audited when? When it is approved by the board of directors and it is also approved by the shareholders. Can you imagine what kind of turmoil and difficulty and hardship the company will have to face, the board of directors will have to face, the shareholders will have to face only to complete this small formality? And therefore, I think we should be and we can be very clear that last audited balance sheet is good enough for this purpose. There is nothing else is required. As an abundant precaution, what you can do, the buyer and the seller can sign a document. They can sign when they sign the contract for the purchase or the sale of the shares. They can, in that contract, they can make one provision, one clause they can make. And what that clause would say, that clause would say that the buyer is willing to purchase the shares, the seller is willing to sell the shares, and both of them are agreeable to use the last audited balance sheet of the company for the financial year ended on this date for this purpose. So they can simply have a document on record. So tomorrow, if it is required by the department, you can say that both of us have agreed and contractually we have no reservation with regard to the valuation based on the last audited balance sheet, and that I think should be good enough for this purpose. Now let's look at the item B of formula A plus B plus C plus D minus L. What does B says? B says the price, remember now you're talking of the special items which are not to be taken at the face value. Face value, that is the value which is mentioned in the balance sheet. Now we are talking of the items whose valuation has to be done separately. So what does it say? It says the price which the jewelry and artistic work would fetch if sold in the open market on the basis of the valuation report obtained from a registered valuer. Now here there are two more options available under this rule, and what those two options are? Those two options are number one, how do you do the valuation of jewelry and the artistic work? So you can do the valuation of jewelry and the artistic work based on if this jewelry and the artistic work was to be sold in the open market, then what price would it fetch? Now that can be taken as the value of the jewelry and the artistic work. Number two, what can be done is, in case if this jewelry or the artistic work has been purchased from a registered dealer, then the invoice of that dealer can be used for the purpose of determination of the fair market value of the jewelry. Now remember, it does not mean that if the company bought jewelry or artistic work 10 years back, and the invoice that was obtained 10 years back when this jewelry or the artistic work was purchased, that invoice cannot be used for the purpose of determining fair market value of this jewelry. Apparently the value at which it was bought 10 years back and the current value is going to be completely different, and therefore invoice can be used to use as a reference for the purpose of valuation of jewelry and of the artistic work only if the purchase is of the recent past. Only if the purchase is of the recent past. If the purchase is not of the recent past, then of course one has to go to a registered valuer, registered for the purpose of income tax, and that is registered valuer under the income tax. He only can give the report. So the company will have to obtain report from such registered valuer, and that is what we should remember. And I'm repeating it once again. For this purpose, the registered valuer is the one who is registered for the income tax purpose and not the one who is registered with IBBI. Then you have item number C. Item number C talks in terms of fair market value of shares and securities. Now, what shares and what securities? So it is possible that this entity whose valuation is being done, or whose shares are proposed to be transferred, and therefore the valuation has to be done. It is possible that this company itself may be holding unquoted shares of some other entity or unquoted other securities in its balance sheet. So now these shares must have been bought sometime in the past, or these securities must have been bought sometime in the past. So obviously for the purpose of valuation under Rule 11 UA1CB for the unquoted shares, these shares and the unsecurities cannot be taken on the value at which they are appearing in the balance sheet. So how will you take the value of these unquoted shares held by the this company, or these unquoted securities held by this company? So again, so for the purpose of finding out the fair market value of the unquoted share held by this entity, whose share you are trying to value, will need to be valued again using the same Rule 11 UA1CB, and these unquoted securities held by this entity will need to be valued as per Rule 11 UA1C and C. So Rule 11 UA1 small c, and that is for unquoted shares. The third component is the immovable properties. Immovable properties. So immovable properties, again friends, cannot be taken as at the value at which they are appearing in the balance sheet. they will again have to be valued separately. So what the rule says? The rule says the value adopted or assessed or assessable by any authority of government for the purpose of payment of stamp duty in respect of immovable property. So that means if the entity that you are trying to value or whose unquoted shares you are trying to value, uh, if it holds land and if it holds building, you cannot take the face value of land as the value. You cannot take the face value of building as appearing in the balance sheet of the company for the purpose of valuation. What you will need to do, you will need to obtain the valuation which is by authority of the government, which is for the purpose of stamp duty, and that value will be taken for the purpose of valuation of these unquoted shares. So that is your A plus B plus C plus D. Now from all this you have to deduct liabilities. Now please remember, as in case of the assets, that not all the assets can be deducted, not all the assets can be added for the purpose of determination of fair market value. Likewise, from the total of all these assets, so आपने क्या किया, आपने ए को लिया, बी को लिया, सी को लिया और डी को लिया, तो आपने ये चारों के एसेट्स का टोटल किया. तो ये जो टोटल आपने किया, इसमें से आपको लाइबिलिटीज़ को डिडक्ट करना है. तो कौन सी लाइबिलिटीज़ को आप डिडक्ट करेंगे? Not all the liabilities which are appearing in the balance sheet of a company, you will be deducting all the liabilities with some exceptions, and what those exceptions are and what is the logic for those exceptions, let us understand them together. So book value of all liabilities shown in the balance sheet, but not including the following amounts. So liability side of the balance sheet, you take all the items all the items, but from that total of all the liabilities, you need to make adjustment for 6 items. 4 of them are here, and what those 6 items are, and let us also understand why they are to be deducted. So first of all, what will need to be excluded? So all the liabilities which need to be deducted from the total of all these assets, all the liabilities which are not to be deducted, what is the logic? So number one, what will not be deducted is the paid up capital in respect of equity shares. So that will not be deducted. And why will that not be deducted? Because what you are doing, you are trying to do the valuation of shares. So if you are trying to do the valuation of shares, obviously shares will not be deducted from the total of all the assets. And why it will not be deducted? Because that is what you are trying to value, because that is what is held by the shareholder, and that is what they want to do the valuation of, and therefore paid up capital in respect of equity share will not be deducted. Will the paid up share capital in respect of preference share be deducted? And the answer is yes. And the answer is yes. And why the answer is yes? Preference share capital, and that is because remember, as far as the equity shareholders are concerned, for the equity shareholders, preference share capital is also a liability, and therefore equity share capital will be excluded, will not be deducted from the total of the assets, but the preference share capital is a liability of the company and thereby of the shareholders, and therefore it will be deducted for sure. Number two is the amount set apart for dividend on preference shares and equity shares. So if the balance sheet that you are talking about contains amount of dividend on the equity shares or on the preference shares, if this dividend has not been declared and approved in the shareholders meeting, remember it will not be deducted. And why it will not be deducted? Please understand, reason behind is very simple. Until the time a dividend is approved in the shareholders meeting, it doesn't become a liability. So it can be deducted only when it becomes a liability. And therefore, if your balance sheet or the balance sheet or the balance sheet whose valuation you're trying to do, if that balance sheet contains amount of dividend, which is not yet approved by the shareholders, that will not be excluded from the deduction. Okay, that when I say that means that will not be deducted. But if the amount of dividend has been declared and approved by the shareholders, then that amount will be deducted from the total of the assets. Number three, reserves and surplus will also be excluded. And why the reserves and surplus will also be excluded? We all understand it very well, because reserves and surplus are nothing but shareholders' money. Equity, paid up capital is also shareholders' money. So the only difference between the equity share capital and the reserves and surplus is equity share capital is money which is brought by the shareholders directly into the company. Reserves and share is the profit which is earned by the company and flowed back into the business, and thereby ultimately it is also money of the shareholders only. And therefore reserves and surplus will also be excluded together with paid up capital and unapproved dividend. Now my question here is that in a balance sheet, not only we have the equity share, preference share, reserves and surplus, sometimes we also have something which is known as share premium. So the question is, will the amount of share premium be also excluded while computing the valuation under Rule 11 UA1CB? And the answer is yes. Share premium will also be excluded. And why share premium will also be excluded? Please remember, equity share capital, reserves and surplus, and the share premium, they are all equity shareholders fund. They are part of the equity shareholders fund. So equity shares, paid up capital on account of equity shares, reserves and surplus, and share premium, they are at a same level, at same footing. And therefore if the company has share premium appearing in the balance sheet, then share premium amount will also be excluded from the computation of fair market value based on Rule 11 UA1CB. And number 4, any amount representing provision for taxation other than any amount of income tax paid, if any. Now in simple words, friends, what does it say? It says that in case if the company has made excess provision on account of the tax, then the amount which is required to be provided for, such excess provision, remember, really speaking, is not a liability of the company. Now since it is not a liability of the company, it will be excluded. I'm sure you will understand the logic. If you understand the logic, and I'm sure understanding the treatment also will not be very difficult. So I think I have discussed this already. Is preference share a deductible liability? And the answer is yes, preference share is a deductible liability. Is share premium deductible liability? And again we have discussed it. Share premium is not a deductible liability. It will be excluded when you are doing the computation of fair market value of unquoted shares as per Rule 11 UA1CB. There are two more items which are to be excluded, and what these two items are, number 5 is any amount representing provision made for liabilities other than ascertained liabilities. See, understand the logic. As I said in the beginning, what is the philosophy and the objective of the department behind this rule? The objective is that assets should not be understated and liabilities should not be overstated. Because if the assets are understated, liabilities are overstated, the net effect is going to be the amount of capital gain that will arise is going to be lower, and the net effect of that is it is going to be a loss to the department as far as the revenue is concerned. So therefore, if a company has made provision for certain liabilities which are not there, then such provisions will also be excluded. Such provisions will not be deducted from the value of the assets. And number 6 is contingent liabilities. So friends, we all understand it very well. Contingent liabilities do not appear in the balance sheet in any case. Now, since they do not appear in the balance sheet in any case, the question of contingent liabilities being deducted from the value of the assets doesn't arise. Doesn't arise. So these are your deductions which are excluded while doing the determination of fair market value. Now the formula also talks in terms of PB and it also talks in terms of PE. Now what is PB? PB is nothing but the number of shares which are proposed to be transferred, and PE is nothing but the total number of shares the entity has. Total number of shares the entity has. You can also understand it slightly differently in terms of number of shares. You can also understand this in terms of paid up value of the shares that are proposed to be transferred is PE, and paid up value of the total equity of the company is PE. Doesn't really matter whether you look at from the perspective of the number of shares or you look at from the perspective of paid up capital. Both will give you the same conclusion, because whether equity or paid up, the ratio is still going to be the same. So friends, this is your Rule 11 UA1CB and the provisions. I hope I have covered it comprehensively. Rahul, I could see few questions being raised. Now that we have some time, I think I would prefer to take the questions because that will be more meaningful. So Rahul, whatever question that you may have received, you can please read them, and I would try to answer them. Or anyone who has raised the question can also unmute themselves and they can ask.
Okay, so we have Riddhi, she's a registered valuer with AARDF. She wants to ask, like, does this mean that we as a registered valuer under IPI are not eligible to undertake 11 UA evaluation?
Okay, so remember 11 UA valuation, of course you are eligible. Of course you are eligible. But then if you are registered for land and building, you do the valuation only of the land and building. If you are registered for other gold and jewelry, then you so depending on what is your registration with the department under rule 35 AB or 34 AB, तो आप उसके हिसाब से वैल्यूएशन कर सकते हैं. Under 11 rule 11 UA1CB also, remember, as I mentioned, there is a provision for the valuation of gold jewelry. There is a provision for there is a provision for valuation of artistic work or unquoted shares or quoted other securities or land and building immovable assets. So wherever the valuation is being done under rule 11 A1CB of unquoted shares, and the entity which is being valued, if that entity is having in its balance sheet jewelry or artistic work or land and building, in such case the registered valuers who are registered for these assets with the income tax authorities, they would be able to do the valuation of these assets only. They will not be able to do the valuation of unquoted shares. Unquoted shares valuation will be done by someone who is registered for valuation of shares, securities, debentures and things like that. I hope that answers his question.
Riddhi, I hope your answer. Okay, Shibashish Majumdar sir, please ask the question. Mr. Shibashish Majumdar.
Yeah, good day, sir. Can you hear me?
Yeah, please.
Yeah, sir. So, in that case, just in continuation of the previous question,
Yes, sir.
suppose an assignment comes for share valuation.
Uh-huh.
So, I have to get all the valuers in the gamut of the calculation as far as A, B, C, and D is concerned. So, all the valuers has to be accrued, and then all they have their own opinion to be forwarded, and somebody has to consolidate the whole thing and create a valuation report.
Okay, I think a very, very, very good question.
This
So,
is one. This is one, sir. This is
okay,
one.
so
And the
let me
continuation,
let
because
me
I am getting into that.
yeah, I'll just
Though I am a land and building valuer,
uh,
I am getting lots of valuation report to be done for equity shares and all.
okay,
So there is another question.
yes.
34AB doesn't have any financial valuers
No, no,
as
it
such.
has. It has. I'm registered under 34AB for the purpose of shares, securities, and debenture.
Acha, that
Yeah,
I didn't know
very
that.
much. No. Actually 34AB has got a huge list of items of all the assets for which you obtain registration with the income tax authorities.
Okay.
Though this
Okay.
section 34AB is part of the Wealth Tax Act, which is now revoked, but that provision is still in use as a reference.
Okay.
Yeah.
So can you just explain this? How exactly? So as a land and building appraiser,
Yes.
I need some sort of financial qualification to certify that document.
Okay. So I
Or how
will.
do you go with?
No, very good question. I will answer it. See, number one, the assignment for valuation of unquoted shares will not go to someone who is registered for with the income tax under 34AB for land and building or for jewelry or for any other plant and machinery or any other asset for that matter. This assignment will go to someone who is registered under 34AB for these shares, securities and debentures and other financial assets. So just to mention it to you, like I am registered with the income tax department under 34AB for the purpose of securities, debentures and other financial assets. So the assignment will come to me because the valuation is required of the unquoted shares. So it will come to me. Now, when the assignment comes to me, what I will do, I will look at the balance sheet of the company. And when I look at the balance sheet of the company, I will see what are the items this balance sheet has. So if I notice that this balance sheet does not have jewelry, the balance sheet does not have land and building, that means what? That means the problem has become very simple. I, as a registered valuer with the income tax, can do the valuation of this entity by myself and close the valuation and finish the matter. So that is situation number one. Situation number two, when I look at the balance sheet, I realize that this balance sheet has got assets of jewelry, artistic work, and also it has got land and building. So now, as a registered valuer for the shares, securities, debentures, and other financial assets, I can do the valuation of unquoted shares. But to support my valuation of the unquoted shares of this company, I will need to authenticate the valuation of jewelry, artistic work, and also land and building, which I am not authorized to do. So what I will do as a registered valuer and the person who's got this assignment, I will in my network I will find out who is registered for doing the valuation of jewelry. I will approach him and get an valuation done from him. Likewise, I will approach someone who is authorized for doing the valuation of land and building and share the information with him, get the valuation done from him. So now that I have report of registered valuer and I'm repeating it once again purposely so that there is a total clarity. Registered valuer as under the income tax would mean someone who is registered as per 34AB. So I will obtain the report from the jewelry valuer. I will obtain the report from the land and building valuer and take those numbers into my calculation, make a report and submit. So this is how the whole process will be completed. I hope that answers both your questions.
I have another question, sir.
So, but I hope your both questions are answered.
Yeah, in continuation to
Okay,
this, I
what
have
we
another
can do,
question.
we can take somebody else's
We,
question, and then we'll, in case of time permits, we'll come to your question also.
okay,
Let us give chance to everyone.
sure.
Thank you, Subhashish, sir. I think we have a question from Mr. Rahul Goyal.
अगर ऐसा हुआ मूर्ख ऐसा लोग काम कर रहा है
Yes, Rahul, please go ahead.
लगने की क्या बात है 271 जाती है अच्छा
आप है ना उनको म्यूट कर दो.
Ketan, ji,
तुमने पूछा क्या किसको?
please mute yourself. Shall I repeat the question again?
Yeah, please go ahead because I could not hear anything.
Okay, so he wants to ask Mr. Rahul Goel, will CCPS stand in the same footing as preferential shares and be deducted? Also, please explain the meaning of other than set apart for depreciation.
Okay, so CCPS cumulative CCPS cumulative convertible preference share, right? Okay, so now this is little tricky, and let me answer it. So cumulative convertible cumulative preference shares by choice by design are to be converted into equity on the designated date, and therefore in my understanding uh, CCPS ultimately are going to be equity shares. So since they are going to be equity shares finally, in my view, they will not be. They will be falling into the same category as the equity shares, share premium, or reserves and surplus. I hope that answers his question.
Thank you, sir. Mr. Vineet Maheshwari, you wanted to ask a question. Can you please ask a question?
Yes, sir. Yeah. Good afternoon, sir.
Good
Sir, I have a
afternoon.
question. In case of a company for which we are doing the valuation has made investment in shares of some unlisted company.
Vineet, just 1 second. Rahul, can you please mute?
Sir, I have tried to expel him. I don't know.
Oh,
There is some issue from his side, so I had
Right.
expelled him. Thank
Okay.
you. Please go
Okay.
ahead.
Thank you, Rahul. Thank you. Yes, Vineet, please
yeah.
go ahead.
Yes, sir. In case of valuation of a company which has made investment in shares of unlisted company,
Uh-huh.
whether it is subsidiary or non-subsidiary,
Uh-huh.
for doing the valuation we have to exercise the same formula for calculating that company as a NAV method.
Yes, so absolutely. Uh, as I as I was mentioning earlier, uh, in case the entity whose shares you are trying to value, and this entity is unlisted, and this entity also has in its balance sheet unquoted share of some other entity. So, for the purpose of doing the valuation of this entity, remember, you will also need to do the valuation of the other entity following the same rule, that is 11 UA 1 CB, if they are equity shares. If the investment is not in equity shares, it is in other securities other than equity shares, and again if they are unlisted, then again you will have to do the valuation of that entity and those unlisted investment under rule 11 UA 1 C, 1 small c and 1 small c. Instead of B, it is going to be C for the purpose of valuation of uh, investment other than equity shares. I hope that answers your question.
Sir, one more thing, sir, whether the method should be the same, that if we are doing the on NAV, so the subsidiary we have to value on the same on the basis of NAV, whether we can uh, do on basis of DCF, yeah, or any other method.
Okay.
Yeah, the method should be the same
So
for our
when
company.
it comes to the unquoted equity shares, uh, the valuation which is prescribed is as per 11 UA 1 CB. So if these are unquoted shares, then the only choice that you have is to follow the NAV. So if they are unquoted, whether of subsidiary or of a holding company or an associate company or completely unrelated company, so long as that entity is unlisted, the valuation will need to be done of those shares as per rule 11 UA 1 CB only.
Right, sir.
Okay.
Right.
Yep.
Understand.
Okay.
Okay. Thank Thank you.
Yes, please. Any other question, Rahul?
Yes, I think Riddhi has one more question.
Please.
Can we use the unaudited balance sheet certified by management for the purpose of valuation of any other date other than 31st March?
Okay. See, as I mentioned uh, in the early part of my discussion, in my view, audited balance sheet as of the last date is good enough. If you take any balance sheet which is certified by the management, please remember it cannot be treated as an audited balance sheet. So, audited balance sheet, the last audited balance sheet is the most authentic document. Any certification, any document certified by the management will always be looked through a magnifying glass with regard to its authenticity. So, audited balance sheet, last audited balance sheet is absolutely fine. And please remember, the items about which the department wants to have the current valuation, they have already specified in the formula. So, if the that audited balance sheet of 31st March 23, suppose if the valuation is to be done today, now, of course, if it is to be done today, then what you would prefer? You would like to wait for some time and maybe let the financial year get over and then do the. But that apart, so 31st March 23 balance sheet which is there, the formula says very clearly. So many of the items are to be taken at the face value. So whatever is the figure given in the balance sheet, take those numbers. For the other items, also it is said very clearly, gold hai, jewelry hai, artistic work hai, land and building hai. If those items are there, then their valuation will have to be done as on the current date. So therefore, in my view, audited balance sheet of the last audited balance sheet is absolutely fine, and I don't see because when you are using last audited balance sheet, please remember you are using an authentic document, and your intention, your objective is not to defraud the department. Your intention is to finish the process in quickest time possible. If just imagine if there are 3 4 such cases, and if they have to obtain audited balance sheet every time, what kind of trouble and inconvenience the company and the shareholders and the board member will have to face in this respect. And a company giving 4 audited balance sheet in 1 year, how would you really say that which one is really authentic, and what is not the guarantee that something going wrong somewhere in those audited balance sheets. So therefore, in my view, and this is the position I think all of us should take with the department, and if collectively we take that position, I am sure department will also appreciate, because they understand as to what is the purpose. So therefore, there is no need to have any accounts which are certified by the management or certified by the auditors or certified by anybody. Just pick up the last audited balance sheet and just have a contract between you, the buyer and seller, saying that we agree for this valuation to be done based on the audited balance sheet of the company as of 31st March 23, and period.
Thank you, Pramod sir.
Yep.
Is there any other questions? We can take a last question if anybody wishes to ask.
Yeah, I have a question.
Please.
Please.
How do you quantify intangible asset as it is a part of A?
Okay, very good question. So fortunately, as far as item A is concerned, what it says, book value of all the assets. So therefore, if it is an intangible asset, you have nothing.
How do I quantify?
No, you don't have to quantify. If it is appearing in the balance sheet, then you take it. If it is not appearing in the balance sheet, then the question does not arise.
But brand value of different companies will be having some intangible value, no, brand equity.
Right.
So how do you, if it is, I don't know, you haven't found that in the balance sheet that the brand equity and intangible value is there?
Okay, I think your question is really an amazing question. Absolutely an amazing question, and I understand where you are coming from. But remember, as far as the formula of 11 UA 1 CB is concerned, it is very very clear and specific as to what is to be included and what is not to be included. So if there is a and this is balance sheet based formula. So if in on the balance sheet, if there is an item of intangible asset which is appearing, then you take that into account for the purpose of determination of fair market value of that unquoted share of that entity. You the method, the formula does not allow you to go out of the formula and try and see if there are certain intangible assets and incorporate those intangible assets also into your calculation. That is not permitted, that is not allowed, that is not the game of the things as far as the department is concerned. So therefore you will have to simply ignore it. It is as simple as, because this is a formula which is based on the balance sheet. Absolutely, and there is no ambiguity about it.
Thank you, sir.
The question of, okay, extending your question, the need for doing the valuation will arise not when you are trying to do the valuation of unquoted share for the purpose of transfer. It is when you are transferring the entire business. When you're transferring the entire business, then the valuation will need to take into account the intangible also. But please remember, at that time you will not be doing the valuation based on the NAV. At that time you will be doing the valuation on the discounted cash flow method and not on the basis of NAV. I hope that answers your question.
A lot of things in mind, sir. Thank you, no problem.
All right. No, you can ask me. So, I mean, we still
No,
have.
that's fine, that's fine.
All right. Okay.
Thank you, Mrs. Bashish, for this insightful answers by Pramod sir. Thank you once again, all the members, for joining this 1 hour session. Yes, of course, it was a very technical one. Hope everybody enjoyed it, and thank you, Pramod sir, once again.
Yes.
Sir, your throat is not well, sir, but still you tried, your best.
Throat is okay, but there are so many